Good morning, everybody. Happy Tuesday. Tuesday, March 11th. It's a bloody Tuesday. Worst day in the market since 2022. Worst day since 2022. Shy, was 2022 better or worse for you than yesterday?
Oh my God, 2022 was a brutal year for me. I aged a bit. I have a couple wrinkles in my face, a couple of gray hairs on my head that just really was driven by that. But yesterday felt like fear. I think that was probably yesterday was probably one of the few days where it reminded me of 2022,
Yeah.
and it was sobering because it's also humbling where we've been accustomed to such a not frothy, but like an incredible environment for the past 2 years when that isn't the status quo. It's not supposed to be that easy. It's going to be, this game is meant to be difficult. So yesterday's a great reminder of like things can get worse. We still, in my opinion, haven't capitulated yet. We're starting to sense that fear, but I mean, I think it could get worse before it gets better, to be honest.
Yeah. I think you're right. Like, I have a lot of friends outside of the industry, and this is the first time since then where we crossed the Rubicon. And I had a text come in yesterday that was like, real talk, should I sell all my stuff? And I was like, ah. And another signal, my guy Seth at Morgan Stanley, shout out to Seth, got the check-in email from him. So it's like, that's the vibe. It's like, we're back to like, okay, people are panicked. We shed $1 trillion in mega cap value in tech. And I think there's a lot of sentiment going on about what people should do. I know yesterday you started to talk about time horizon. Shy. I know we have Josh Brown shared a really interesting post from Reddit that I think captures the moment. And essentially, it's sort of what my friend was saying. Like, is this the end? Do I get out? I mean, I think this is a moment where, as our friend Robert Croak would say, when in doubt, zoom out. But what do you make of this kind of thing when you see this on a forum like Wall Street Bets or Reddit?
I mean, I think it's narrative follows price action. I want to say that's a very real thing. Psychology is such a massive component towards investing. I think it's under discussed a lot. So when you see, I don't know, Nasdaq going down 13% in a matter of weeks, it feels bubble bursty because it's happening so quickly. And 2022 is just 3 years ago, so it is still on top of people's mind of like I don't want to experience that again. Like I saw what that did for my net worth, my mood, etc. Like I don't want to experience that again. Like should I prevent myself from going down that path? And I do think that's what Josh Brown is saying, holding cash position, like that's what I am advising to my subscribers. Like I think it's really important to know what kind of investing style you have or investing environment that you're able to participate in. For me, I'm fortunate enough to be in a position where I have 3 to 4% DC cash coming to the portfolio every month. So knowing when I make ads today, it's not on a fixed amount of my portfolio. I know if I run out in a couple weeks, I'll have more cash to come back into the portfolio. So it's not an endless flow, but I have on top of my mind like if it goes lower, I'll have more capital down dry powder on the sidelines to add more in the coming weeks. That's not I'm not ignorant. Like I know that's not the case for a lot of investors out there. So if you're
Yeah.
one of those investors that have the fixed amount, like you have $10,000 in your portfolio, you can't add any more for months, years. You need to raise cash. This is the time to get defensive. The
Yeah.
indices broke the 200-day SMA level without second guessing it at all. And QQQ even tried retesting it last week, and that support turned to resistance. It feels like we're going to go lower before we get higher. So
Yeah.
knowing that, just raise cash, 100%.
Yeah, and that's the question my friend was getting at of if you don't have a huge cash position right now, is it too late? Like he's asking, do I sell and get some cash now, potentially lock in the losses? I know everyone's looking at Warren Buffett like, damn, this guy did it again. He's got the most cash he's ever had just sitting there right before all this went down. But for someone who's thinking like that, um, unable to build on top like you're doing with a new cash position over time, uh, what would you say to someone like my friend who's like, should I sell now so I have some cash? Like, how long is this going to last?
I do. You do sell 10 to 15%. I would advise. Again, not financial advice. Sorry, guys. Should say that first. But if I was in your friend's position, fixed amount, sell 10 to 15%, and as soon as the indices recover from their 200-day SMA level, and the noise clears out, then I would participate. Like it's okay missing the first 10% move. That's what I'm trying. Like it's really
Mhm.
important for audiences and retail investors like to know that, or you don't have to catch a falling knife. Things could look like Tesla under 200 bucks. If it hits under 200 bucks today, I think it's going to be cheap. You have JP Morgan today announcing an $800 price target. That's a 300x.
Whoa.
However, buying Tesla at 250, that could happen if the indices recover and you can hold from 250 to 800. That first 15, 20% you missed out on, fine. But the noise cleared out and it's not the floor is a lot more stable and you don't feel like you're spiraling. That's okay. Like that's kind of the mentality that you should have where you'll miss the first move and that's totally fine. It just gave you more visibility of what the future is going to be like and then you can adjust accordingly. But a lot of investors like they don't do this every day. They don't follow the stuff that we do like every single day like it's a part of our lives and they need to be a little more cautious than the rest of us. And that's my advice. Just like wait it out until things iron out a bit and the noise clears.
Yeah, what do you make of? I think a lot of retail investors now, some of their portfolios similar to your style, just thematic, investing in trends, mega trends over time. And then some tend to have some play money where they'd like to jump on volatile situations. And this seems like a moment where there could be opportunities. Obviously, it's risky. I saw a lot of chatter on X and Reddit of everyone talking about the short Tesla ETFs or the 3x leveraged inverse. And it feels like, I'm curious what you think. It's too late for that, right? If you didn't make that move, it's over. So for people thinking that way, are there riskier things that people are looking at right now, just given how volatile things are?
Yeah, so it's again funny how sentiment follows price action again. You guys heard me like every morning on the stream, like for weeks, I'm buying cheap hedges. VIX is at 14. I think I bought literally I gave you guys verbatim June and September expiration long dated puts because I want to buy hedging when it's cheap, when I anticipate the Trump's first 100 days to be volatile, choppy, because he's doing too much too quickly. Short term pain, potentially for the long term gain, but that short term pain was not being priced into the market at all when it was at near all time highs and big tech disappointed its previous earnings cycle. I was like, there's a disconnect happening right now. So like I hope I'm wrong, but if I am right, I'm gonna buy some cheap hedges right now when VIX is at 14. The VIX is at 30 now. That essentially means that the hedging is twice as expensive now to buy those puts than it was just a month ago. So you have to ask like what's being priced in. Like a lot of fear and FUD is being priced into the contracts right now. So there's gonna be less juice to be squeezed if we continue going lower because the fear already happened. And for Tesla specifically, the move already happened on Tesla. What going from 400, it went down 60% essentially in a matter of 2 months. That major move already occurred. So if you want to do it right now, it's dangerous, especially with the daily RSI is at 20 for Tesla, which is I think the lowest it's been in a decade. That means it's extremely oversold in the near term. And I think that a lot of people just want to get into something after they see a the price reaction happen to it because they feel somewhat safe. But that's not the way this game works. It's not. You kind of have to be first before the mass audiences see it. For Tesla, for example, or even the indices right now, you can't hedge. You can't buy these leveraged puts because the move has occurred already so quickly, and you're going to be holding the bag if we have a dead cat bounce.
Yeah.
And just raise that cash and be safe. That's my biggest advice.
What about going the opposite way? Like going leveraged bull Tesla right now because everything's fallen to earth. Like they're down 40% year to date. I'm just putting my mind, I'm not like a trader. I'm putting my mind in the perspective of I think we are trained in these markets to say, okay, something's going on. There's a move to be made. What's my move? Like, is that a rational thought? Or is that also a terrible idea?
I think it's I think it's a terrible. No, it's not terrible. I mean, first off,
It's
triple
not my
leverage.
idea. It's a hypothetical.
Oh,
So you can
100%,
say it's a
100%,
shitty idea. That's okay.
100%.
Okay.
So I think triple levered leverage vehicles are great. Tools are great vehicles during a raging bull market or a trend up market. When
Hmm.
things are choppy like this, that's not a vehicle of trading that anyone should participate in at all. Like doesn't matter what it's again, it's all up to your time horizons, guys. Like if you're a trader, then I don't know, I would sell puts then. Like there's safer ways of gaining some kind of return on if you bet there's going to be a bounce. That's not triple leverage because those tools aren't made for long-term investing and you're going to be holding the bag. There's a leakage required that happens on those kind of ETFs that if you hold long-term, like you're just gonna, it doesn't make sense. And you don't really need to, it's like not a marathon, this game. I mean, it's not a sprint, guys. This game is a marathon. So if you think Tesla's going to have a bounce, like I would not go the triple leverage route because it could go lower. Worst case, like if you really want to get bullish on Tesla on 150 and you would buy a lot of shares at 150, sell some 150 puts on Tesla. So if it does hit that level, you'll buy those shares that you're selling, like and those puts. Like that's the kind of mentality you need to have. And I don't think right now greed is at all should be at play when the VIX is at 30. That's not my cup of tea at all.
Yeah. It is. It's hard living in, the world of Polymarket and DraftKings and not looking at times like this, like, ooh, got to make a move. But you're right. Like rational thought, apply principles. I want to go back to Tesla real quick. Because that's down, as I said, 40%. And then I think it was last night, Trump went on Truth Social and said he was going to buy a Tesla. I wonder which Tesla he's going to buy. Like, I don't see him in a Cybertruck, but I
I
also,
mean,
like, which one is it?
is
Um,
it, he's gonna probably buy it for Barron, his
for
drive around
Barron,
NYU.
I don't think Barron would fit in anything other than a Cybertruck. The kid is huge. Do you think this can turn the tide of? I know there's statistics show Republicans are less likely to buy EV historically, and especially Tesla. Is this going to start a movement where you now have a complete flippage of the political leanings of their core customer base?
I think it's a nice sentiment. I have a difficult time believing that this is a needle mover for millions of Americans. I really do. I don't think it's maybe, I don't know, maybe they're a lot more patriotic than I think they are. Maybe I just don't understand it well. But I just think that the better read through for this might be that there's going to be some kind of government intervention that's going to help Tesla substantially. That's going to allow them to reduce the cost of the cars. And I think, um, like Doge, for example, like I think maybe there's going to be some kind of Doge angle on amplifying EVs, specifically for Tesla. That's going to help reduce the cost and I don't know, address the potential excess capacity. But like either way, like right now, there's been no help from the government for Tesla, and Elon is the first buddy still.
I mean, they've
I
gotten
think,
some help in the past.
in no, not this year though,
Okay,
in
yeah,
past, yeah, but not in a Trump-led presidency is what I'm
yeah,
trying to say. And I think a lot of Tesla stock in November, December was pricing in, wow, he just, I don't know if he moved completely the election, but he was the biggest help for Trump to win, and
yeah,
Trump's going to help him out. They're buddies, so who knows what's going to occur in that Tesla umbrella of innovation that's going to get streamlined. That
yeah.
hasn't come at place come at play right now. I think right now the sentiment is clearly um, on Tesla is just like the really weak January sales. They're down 45%, like you're
Right.
referencing. Like I think the liberals are just there's
They're
half
done.
the country. Yeah, they're done
They're
with it.
defacing their own cars.
So like
Um,
yeah, I mean, it's tricky.
yeah, I mean, also like China's making them way cheaper for obvious reasons. It's just weird to think about the government intervening to help Tesla because that feels very like something the other side would be doing in terms of like United Auto Worker support. Like everything's kind of like shifting in real time. It's sort of like I think about like history class growing up when like one political party believed one thing and then like 10 years later it was the exact opposite and like everything switched. But it is weird to think about given Elon's involvement in like dismantling and like optimizing government programs. Like then the government then going back to help them out. But you're right. I think they can't compete on price. So it's going to be very, very interesting.
Yeah, I mean, it's all such a show, to be honest.
Yeah.
That's the thing. Like, I think every move is a chess move in some way. So maybe I don't know, they're reducing so many other things so they can have the luxury of doing something that's going to benefit Elon. That could be at play. You just never
Yeah.
know. So I don't know. I
Well,
just think, sorry.
oh no, go ahead.
No, I was gonna say I just think like it's really important to like know what kind of investor you are in Tesla. Like for me, I got in 2 years ago with autonomy AI goggles on. I didn't get in with EV goggles. So
Hmm.
I think the EV is part of their business is just a Trojan horse for full scale autonomy. And I can care less about deliveries missing. I know consumers they're going to adopt eventually to the most convenient and price effective strategy. And that's going to be Tesla if Elon solves autonomy at scale. If he does that, Cybercab network and the reduction of costs is going to result in pricing going lower. Are you going to tell me that people believe so strongly against Elon that they're going to spend more money and they're going to make their lives even more difficult every single day? No, that's just not,
Yeah.
unfortunately, that's not the American way. And
Yeah.
especially when like in the capitalism is about to get even more brutal in the post AI world with workforce reduction, inflation is clearly going to go higher again. Like they don't have the luxury to do this just to not capitalize on what Elon's trying to build. So that's just my take on that.
I think that's such a good point because you're in LA, I'm in New York. I think,
Hmm.
we live in weird areas where like people will make moral decisions that like screw themselves financially sometimes. And I think most people are looking ahead to like their family, their table, their car, all those things. And the sort of morality or where you fall kind of falls by the wayside. If Amazon can get you a product in 2 days and it's cheap, it's like, who cares what you think of any of that? So I think you're right. It is going to get
That's
way
a
more
great
hardcore.
point.
What?
So imagine if you guys stopped, you're not gonna buy Prime anymore because it took all those mom and pop shops away, like business away. Essentially, you guys didn't do that. You guys all
Yeah.
went Amazon and you guys went Prime, convenience and pricing. The same mentality is gonna happen in transportation. That's a logistics angle for Amazon. Tesla's going to offer the transportation angle of that for consumers' lives. And you saw everyone in the world does Amazon Prime essentially. Who knows if like, again, there's zero evidence of this, but if there's any kind of subscription model that Tesla's going to start creating in their Cybercab network that's eerily similar to Prime, where you pay I don't know, $100 a month and you have a subscription to the Cybercab network to just get to work and back in the same radius, that is a very easy lever they can pull once they scale autonomy. Like that's just an example
Hmm.
of some pivots they can make. And like again, there's no evidence. I've never read that. Just thought of it right now as you're speaking, but it
Free
makes sense.
idea. Someone writing this down. I love it. Yeah. I mean, well, hopefully those two don't fall out of favor with each other and they can keep the friendship alive. But I don't think that's going to happen. Let's go over to Delta because they had a bit of a bumpy landing in their earnings. They're down 15%. They cut their outlook. Similar to sentiments echoed by American and Southwest, the airlines are worried. I think it goes back to what you were saying, Shy, like the mentality right now of fear. Are people booking less vacations? Are companies cutting back on work trips? What do you make of this? Do you think this is sort of a knee-jerk reaction to the markets overall, or do you think they're seeing something that perhaps we're not?
So a couple things come to mind. I come from the corporate strategy side, and I'm fully aware that T&E is getting slashed, and T&E is travel entertainment. That's just getting slashed, and I think they're essentially not egging on their workforce, but like them people leaving voluntarily is being shrugged off. Like, okay, fine. It's
Yep.
not like we need you anymore. Like you're pivotal. Like, okay, fine. They're like kind of testing the boundaries of the most efficient course on their workforce in their organization, and like, noticing like even though they had layoffs, like the product hasn't really suffered too much. Let's see how much we can push this type of thing, and we're gonna slash T&E. That's another Trojan horse of getting people to leave on their own accord. So that's part A. Part B is I do think the government's spending reduction is a real thing that affects multiple industries. Said that before, where it's not as binary as a lot of people think. It's their hands are intertwined with so many different industries. Travel's another one. Like if there's less government officials, like they're traveling less. They just are, and they substantially because like a lot of the business doesn't just happen in DC. Like they have to travel across just the country substantially. That is going to get reduced as well. And consumer sentiment, like people aren't dumb. They're seeing what's in the headlines. They're seeing this tariff wars, and they're reading upon pricing from like the earnings from Walmart, Target, etc. Like pricing is going to increase again because they have to respond to the potential tariffs, and that's going to come at the expense of consumers. Does that sound familiar? Same thing happened during COVID, where these companies, retailers, had to adjust their pricing, and it was at the expense of consumers. That same thing might occur again this year. So now people are kind of preparing for that, preparing for the worst. Like if the tariff wars are over and like things go back to normal, which I don't think it's going to happen anytime soon, but if it does, I think maybe consumers are going to they won't tighten the belt as much. But as of right now, enterprises, consumers, they're all preparing for elongated tariff war, and that's affecting spending across the board.
Yeah. It is it's fascinating too, just think of the sociology of like how people are connected now versus like back in the 80s, 90s, even at the dot-com bubble with social media. Like these the bad vibes spread so quickly, the FUD spread so quickly. It seems like it's even uncharted territory from where we were at in 2020 because that was like pre Wall Street bets blowing up really like we're in like a totally different environment now, and it just seems like everything's even more accelerated in the information sharing, which could be good and bad, right? Like if things start turning around and that spreads, that could potentially recover things faster.
Yeah, I think there is it's the environment's going to continue being very hostile in my opinion. I think people are now coming like we've been in recession for years, guys. Like we have. Like we saw it firsthand in business spending, but I think with the economy, it didn't like we didn't see it as much in the data, but that was inflated from just government spending. Like it was masking the recession that was actually under the hood. And you saw clearly with businesses. Business spending is the best benchmark of what the health is of their environment. It is. And we saw that recession begin in 2022, 2023 in business spending. And it hasn't really picked up as much as you anticipate. Right now, everything's just big tech spending on CapEx. That's driving all the business spending environment to increase. But like really, if you look even deeper, like it just hasn't recovered since 2022. It just hasn't yet. And I think I'm like some the sentiment is going to get somewhat fearful even more, and you're going to see some troubling data come out probably on even more consumer spending is going to go worse and worse. Like that's really troubling. You're seeing Trump make comments that he's making his moves that's not tracking the stock market. Like if there's any validity to that, that's semi worrisome because that's not Trump 1.0. That's very much the new Trump, and that's he is focusing on patriotism, and I think a lot of people are not a lot of people. I think a lot of middle America, from what I'm reading, they're focusing more on keeping their jobs in house, like keeping jobs in USA, and they're okay with spending more money on goods as a result of that. The issue with that is that's great for middle America, but for the whole nation as a whole, like increased cost of goods is an awful thing for consumers. It's just so bad, and we don't have that earnings gap or wages gap to match up with that. It's going to continue to have that consumer spend crack and crack and crack. So like I don't know. Right now, it's deglobalization is a real thing, and I think that U.S. consumers are picking up the bill on all the Doge moves, and that's unfortunate for the short term. But I think long, we'll see how if it bears for long term. But as a short term, it's It's not a great environment. It's very bad.
Yeah, it'll be for people who feel that way, like how soon they see that payback on the sacrifice they make on the cost of goods. How soon are the jobs created? Are these data centers being built out in? I know Vivek Ramaswamy's talking about making Ohio like turning the Rust Belt into the Bronze Belt or something like that. But like that needs to happen relatively quickly. I hope I don't mess this up. I think it was Walmart's CEO yesterday came out and said they had data that like it's getting tight. Like most people live month to month, just realistically. It's getting tight at the end of the month. Like they're buying fewer things as the month goes on, smaller portions. Like you see it like the money's running out quicker on a monthly basis, which I think for a lot of families, like that's super scary. And I think that's what you're starting to sort of feel is happening.
Totally. Totally. And I think, yeah, I mean, a lot of people, again, fear the worst when things change. So this could be just everyone fearing the worst, pricing the worst. And I think we have to be cautious that this is all based on a catalytic event. It's nothing substantial, like it's nothing deeply structurally wrong. It's just we're playing in a high stakes poker game that can literally end at a flip of a switch. Like we just don't know when that's going to occur. So that gives me somewhat of like relief that it doesn't feel structurally flawed yet. It's just people, enterprises and consumers are just front running a potential inevitability of we're in a tariff wars for longer. But that can change. Like it's not like the housing crash that we had in 2008 where like that was a structural reason why we're pulling back. Structurally, that's going to take a long time to get out of. This doesn't really have that as much, but also like I don't know if we're in these tariff wars for over a year, that's going to be structurally detrimental. It's going to be, and I think when you mention like when are we going to see that bear fruit, it's not going to happen in months. It's going to be years, and like I do have some worries that this could be a lost decade. I don't know. Not like the
Oh
rest of the
my
decade. Like
God,
no,
Shy.
the rest. Like if this tariff wars for like 3 years, like I'd be worried. And like I don't know. Like there's ways this could snowball quickly. Like if
Yeah.
you see China say, "Oh, this is our chance to invade Taiwan," that could be the death nail on all this. You can see if the if China and Russia like just like pair up for some odd reason, that's death nail, and you just see like consumer credit just get significantly worse because this tariff war and the increase of cost of goods and inflation is still substantially higher than it was a couple years ago, and now it's going to get even more higher. Maybe that incremental bump break the consumers back. You just don't know when we're at that point, and
Hmm.
that's what's a little alarming. But you have to take a month to month. Like as of right now, I'm buying still stocks. Like I'm being more
I was gonna ask
defensive.
if you went shopping yesterday.
I did went shopping yesterday, but on select names. I will say like I didn't add to my speculative names. Like right now it's time to only add to defensive, in my
Okay.
opinion. And I only have a 4% cash position now. I have no more hedges. I sold my hedges yesterday because I think I mentioned earlier like I think
Yeah.
we're gonna have a near term bounce, but I have a 4% cash position. I had a 12% a month ago, so it's dwindling down. I'm gonna be more a little cautious, but also like I'm highly advising it's raise cash. Like I think things are going to get potentially worse. Like get defensive as long as SPY is below what is it 572. Jeez, we're 3% below the 200-day moving average. I yeah, the
Something to
market's selling off a
celebrate.
bit.
It's opening
Wow.
bell. What were you saying, Shy, about the spy?
Yeah, I think as long as SPY is below 572, you be defensive. You just do.
Okay.
You raise that cash. You don't infuse that cash in the market.
And why is that the line for you?
There's like the chart works in four stages. Stage one, stage two, stage three, stage four. Stage two is when all the money's made. Stage four is when all the money's lost.
Okay.
So a lot of people, like you can see that stage three range bound and the stage four hits is typically when it's below the 200-day moving average. So a lot of algos, a lot of traders, like they're out of a position stock once that stage four gets initiated, and that occurs when the 200-day SMA level breaks.
Okay.
So that's when like if you look at what when was it? back in, let's go back to 2022 because a lot of people are talking about 2022. When we broke that 200-day SMA level on 2022, it was at 368, 370. If you sold out on everything, the SPY went all the way down to 260, 250. You missed an additional
Wow.
25% correction in SPY.
Whoa.
And if you just waited for them to SPY to recover to the 200-day moving average, you would have gone to SPY at 290. But you got it at 360. But you still got in at 290 even when you wait till the noise to clear. That's what I mean of like just wait until we recover the 200-day moving average. Like you won't catch that falling knife. You missed out on that 260 to 290 move, but who cares? That's a 10% move. You got noise, you got clarity, and you sold out at 360 and you got back in 290. That's a great move. I think right now you kind of need to have. That's why I'm like, that's the defensive mentality you need to have and like orchestrate. And I, eh, I wish. Hold on, let me see this.
I like this
I missed that.
articulation though, because it's like defense wins championships in this regard. And I think when the market's booming, it's all offense. And now it's like a completely different strategy that you're applying in the new environment. And I think if people have kind of just been in it when things are ripping, they haven't had to do this before.
So, am I able to share my screen, Keith? Okay. So this is nuts. I did an end of the year analysis to my subscribers because I always did appraisal. I forgot about it until like I went back in the SPY monthly chart. I'm gonna share what I share with them, and it's kind of working, playing out perfectly, which is a little alarming. Let me share my screen, entire screen. All right, so I use TrendSpider. It's one of my favorite tools out there. Every time the daily RSI hit an 80, the monthly RSI hit an 75 plus score. So anything above 70 is extremely overbought. And there's going to be some kind of return to the mean on 50, for example. So when it hits a 75 to 80 on a monthly chart, that means way overextended. We've hit that 4 times in the past 20 years almost. First time, June 20, 2007. We all know what happened. We dipped 54% across 1 year and 9 months. Big sell off. Next time that occurred, 2018, we had a 17% correction in 11 months. The next time we hit it, look, 2022, 26% in 10 months. I was like, oh God, guys, I think we're approaching that right now. I was a little early. I was like, in November or December, it looked like this is the first time it hit this level. And every time it hit that level in the past 20 years, we've pulled back. I was like, I could see an 18% correction sometime next 11 months. Perfectly happening right now. And this kind of works out perfectly where you see this, the 40 as, I see that, I think this is on a monthly, it's better. The 50 SMA level on the monthly chart, it kind of has been perfectly bouncing on this for the extremely long trend. So this 18% correction, I was like, I think SPY hits $500, which is crazy sometime this year. I hope this
Wow.
doesn't occur, but like that's what the charts are showing me. That kind of perfectly aligns when this trend catches up to it. It's weird how things work out that way. And I mean, I don't wish because I'm a long-term investor at the end of the day. I don't like go all cash, but like this is another reason why I bought hedges, but it's working out perfectly. And I think that's why there might be an additional 10% move sometime this year. But like, I don't want to be the perma bear, but that's what the chart showed me in the past 20 years. So like, I want to share that where it's working out to the dots because I took this 18% move as an average essentially on there's some data behind it on why that was, but either way, alarming trend. I want to share that. I forgot I did
Nostradamus,
that.
when did you make that call? You said November?
It was in December. I was like,
Oh.
during my end of the year analysis, I was like, I think there might be a really bloody year, but like I'm still investing on like AI industrial revolution because I think we're in the fourth industrial revolution. Just I think big tech will be a dud type of year, and I think it's going to cause a lot of fear and take the indices down with it. And I mean, I wish I acted obviously more about it, but either way, I mean, it's really important to kind of have like I'm a perma bull, but like you need to wear multiple hats. You just do. Like, I'm not a technical guy at all. I'm really not. I can use it as a tool in my decision making. Clearly, if I was a technical guy, I would just go full on bear from what I just did, went over. But like, I dictate my behavior. I had a 12% cash. I did some hedges. But like, so far, I'm a little right. But yeah, it's weird.
It's like one of those things where like you're right, but you're not exactly happy to be right. You're like, I
Yeah.
think I'm glad I was right, but like I wish I wasn't right. Um, let's shift over to, I mean, we got the JOLTS data coming out soon here in about 20 minutes. Any predictions on that one while we're calling things?
It's gonna be bad. I don't know. I mean, I think all job data is pretty bad. But
Yeah.
you have to ask yourself like how much fear is being priced into the market already on that bad data. So
Do you
either
see
way,
them? Do you see like Mag 7 big tech with kind of the bloodiness going on doing more waves of mass layoffs?
yeah, 100%. I think 100% middle management is going to be screwed a bit.
Yeah.
I think you're just seeing signs of like I think consistently there's gonna be like 10 to 15% reduction in middle management every year for like the next couple of years. I just think that's just the way it's going to go. I think you're seeing BI tools out there do a lot of what directors of corporate strategy can do, and I, I'm a director of corporate strategy for a Fortune 5 company. Like I'm saying this like as like once I started seeing the tea leaves like 2 years ago in AI, I was like, I need to adjust, and that was when I decided like also my fiance helped me push, but I was like, I got to do what I want to do, which is the being stock savvy shy and stuff.
Yeah.
Like I was like, this is the time to do it because I just don't think the pathway of being a director to a VP, I think got extended significantly in a post
Yeah.
AI world. Like, and VPs might not even exist, to be honest. In like 5 to 7, they're gonna exist, but like, there's not gonna be 3 or 4 VPs to each C-suite. Those days are over. I think maybe it's 1, 2, and then maybe uh, again not 2 directors, maybe 3 directors. I think managers and analysts. I think they're gonna be intertwine into some new role. Like I think consultant is going to be the new term. There's not going to be really analyst because let's be honest, AI is a freaking analyst. Like why do you need an analyst?
Mm-hmm.
Managers is like directors manage teams. Like why do you need a manager typically technically? I think there's going to be the future workforce world and enterprises will be contract contract consultants, directors, VPs, C-suite. And I think
Yeah.
that team is going to dwindle down. And I think a lot of consultants are going to be on contract terms. Prove that you're going to over earn. You're going to make an ROI on us spending money on you working here. And if you prove that you belong, you'll get promoted to director eventually. But it's going to be a Hunger Game type of environment if you're below a director in the future workforce.
Yeah, I agree. I think the state of the job market now, there's a lot of conversations on like career diversification, which is like a new ish concept. I have a friend who runs a big community of like fractional workers, and that's sort of what I do, where I'm like part time at like 7 different things. And it is companies are favoring that because it does allow them to be more nimble, especially like
Hmm.
early stage companies. They're not adding a headcount, they're not adding another health insurance policy. They can say, okay, I need this for 3 months and we can extend or we cannot. So I think it just completely flips the whole uh, the market on its head in terms of jobs. And there's a lot of industries where like tech, that's kind of a normal thing now, but there's industries where that's totally new. And
Hmm.
I could even see that becoming a thing in the federal government, which would be interesting as well.
Yeah, I mean, guys, feels like for the first time in a long time, employees had the power finally during COVID. It was so short lived,
Yeah.
and I also think it rubbed a lot of the enterprises the wrong way or companies the wrong way
Yeah.
because they were finally in a seat that they had no leverage in, and I think they felt exploited a bit, which they kind of did. Not gonna lie, like employees just had finally had the power in their hands and leverage, and they took advantage of it on pay, convenience, etc. Now, clearly, the employers have the power again, and even more. But once, as an employee, you enter that mentality of like you have that power, it's really hard to get back to what it was like before, where going to work 5 days a week.
Yeah.
I physically can't imagine doing that again. But before COVID, that was the status quo. Another
Yeah.
one is just like, I don't know, working 60, 70-hour work weeks, like in iBanking. Like those days are difficult for me of like committing your whole life to an
Yeah.
organization is very difficult when you had that work-life balance during COVID. So
Yeah.
it's a tricky time psychology to be like in this world right now, to be
Yeah.
honest.
Well, we all got to be like shine and diversify. I actually picked up my spin instructor license a few years ago. So if shit hits the fan, you guys can catch me
You'll spin
probably
your
not
way
on
out of it.
Peloton, probably at some crap gym. Let's stay on tech for a second because there was some kind of big news coming out of the tech world. Asana its founder, Dustin Moskowitz, is retiring. I've read a lot about this guy. So Asana is actually a Sanskrit word. He's famously a Buddhist, and he's run this company as a Buddhist, and there's a lot written about it because it's a totally different philosophy than a lot of companies. And of course, he was OG at Facebook too, but that is a company that is extremely intertwined with its founder, as you can see by what's going on with the price right now. Have any thoughts on Asana over there, Shy?
I think the CRM space is one of the most vulnerable components of the enterprise ecosystem that will get disrupted by AI. Customer relation markets, guys. So I just think there's not that much of a differentiation between all of them. Like, is the ecosystem isn't as sticky as you'd think. I think you guys heard my thesis on the workforce in the next like 5, 7 years. This is all seat-based licensing models. So if there's gonna be less employees, there's gonna be less. That's gonna be a massive revenue headwind for CRMs out there. And
Mm-hmm.
there's so many in this space. It's crowded. You have Asana, you have Monday, you have HubSpot, you have Salesforce, you have Atlassian who has a component of that. You have Adobe who has a component of that. Like, there's just so many players that it's really hard to have the pricing power that you need to survive this kind of potential disruption. And I think Asana, like, there's gonna be one mid-market player in CRM space. There's going to be, and right now,
Mm-hmm.
Monday.com is showing me every sign that they're going to be that winner over Asana. And I think Asana, I think maybe the founder has been buying so much of the shares of the stock for such a long time. Like, I think he owns 55% of the equity in this name. It's essentially his company, his baby. He's stepping down is not a vote of confidence at
Mm-hmm.
all. It's like not waving the white flag, but
Yeah.
it's not working. And I think at a time when AI is going to cannibalize that space, it's a really bad poor timing on their part of like having the CEO founder leave.
Yeah.
Um, so
I
I think they're
think
going to get
there's
acquired.
also with him that like it is that there's a spiritual component with someone like that where like, yeah, he doesn't see work as the be all end all. But I think it is interesting, like between even because I use these tools every day at Asana, Monday. To me, that's like what the bet you're making with those is that's replacing the middle management. It's like workflow automation. There's AI. There's somebody reminding you to do a task or just doing it. If you can set up a workflow and it just goes for you, and that's replacing like the human beings. And then the CRMs are a little bit different because that's more of like a data play. But you're right in that they both keep building these ancillary features where they start to intermingle. But I've seen this firsthand. A lot of my clients, people I work with, why do we need Asana? Can we do this in a Google document? I mean, it's uh, it's going to be, I think, the AI and the automation piece. I think we saw yesterday ServiceNow, which is a big player, I think, across both CRM and workflow management, but mostly workflow management. They dropped, I think, a few billion on an AI company. Um, so that it's like that's the piece that's interesting to see is like this tech layer becomes the middle management at some point, and who's gonna win out there? Who knows? If you open these platforms, they all basically do the same thing.
I mean, I don't think you can be a standalone, to be honest. That's the issue. Like, I think Asana's getting acquired by Atlassian or Adobe or Salesforce. I mean, what you can buy them right now for like $3 billion, and that's not that much of a pretty penny.
Yeah.
It's just there's going to be a consolidation, and I think if I had to put my money on the two CRMs that are going to survive, three CRMs are going to survive this AI cannibalization, it's clearly Salesforce is going to be the no-brainer in my opinion because they've been here for decades. They've proven they can acquire themselves into relevance because they haven't done anything organically in a decade. Ever since the cloud days, like they just acquired BI tools, and that's why a lot of their growth is inorganic. But like it works for them because they're still at have a seat at the table.
Yeah.
HubSpot, they were supposed to get acquired last year. They didn't work out, but their data is just like whoever acquires them is going to have an incredible advantage in the data that's in HubSpot's ecosystem. They just are going to. So I think their data cemented themselves to survive this. And Monday.com is looking like the clear mid-market winner. It just is. But I think margins, I think the margins are going to compress in Monday.com eventually from the bigger players.
Yeah.
And
And
like,
with the automation of the things they were good at before, like Salesforce being excellent at certain things in the past might not translate though. Like their last earnings, they totally whiffed on their like AI agents. Like nobody was buying those. Could be because they were like early, but they were like all in. Like every interview Benioff was like agents for everything. And then they reported and it was like not as many people bought them, which could just be they're ahead of the market. But that's kind of like who's going to be better at that stage, I think is like to be determined and something to watch. And to your point, is it going to be like inorganically they're acquiring companies that do this like ServiceNow did, or are they going to try to build it themselves like Salesforce?
yeah, I mean,
I don't like the
I
idea of Asana or anyone else replacing my job, but that's I feel it sometimes in the day to day where I'm like, oh shit, like this was what I was doing. This tool is what I was doing when I started my career for 3 years, and now it's just doing it, and
I
that's
mean,
what's
yeah,
crazy.
automating repetitive tasks is such an easy like thing. That's one of the just replacers of
Yeah,
workforce. Like it just is because there's no semantic layer in what you're doing. It's just
in the UI
mindless a
now,
little.
it's so you don't have to be an engineer. You build workflows. You're like, if this, then that. If that, then this. Like even in HubSpot, you can do that. Target this person if they click this. If not, do this. And you're just building a flow chart. So there's no coding, and that's the part where it's like, whoa, that's crazy. But I digress. Let's talk about Kohl's for a second. Way on the other side of the world is Asana. Do you shop at Kohl's? Do you have any
Oh,
Kohl's
I am a
cash?
regular member of Kohl's. Of course, I buy all my jewelry there. I buy all my swag there. No, I go there to pick up my Amazon packages at times.
Yeah, they have a good workout clothes, I'll say. They are having a bad day though. So let's look at what's going on with them. Of course, guys, remember on StockTwits, you can always see why things are moving. So that's a cool little AI feature that's built out. And yeah, they had earnings. They had earnings, and their revenue was not so great. So another not great indicator on consumer spending looks like Shy.
It's a dead company, guys. Kohl's like that business model is just like not brick and mortar is just you doesn't work. It just really does. Even Amazon attempted to do. I just do a brick and mortar store, make it like a little futuristic with not having workers there just scan in and out. Like that didn't work for them.
Yeah.
That's not a business model anymore. Brick and mortar and Kohl's like again maybe it's just out of my bubble. I'm not in that demo. I don't know. I just like they just feel they tell me everything that they're gonna be like Bed Bath and Beyond. Like they're just going to go down the path, get sold for parts.
Mhm.
I don't even know what parts that's attractive enough in Kohl's, but maybe it's their warehouse real estate locations for warehouses for Amazon. That could be the case. Um, yeah, I mean, I just
It's an end of an era. I thought you
yeah.
were going to say you moved a significant allocation of your portfolio to Kohl's Cash in this market, Shy.
That they're trying to create a Starbucks ecosystem. I give it to them.
Yeah, I mean you're right. It's a tough one. It's the role of brick and mortar now is so different. I talked to a CEO of that company Lovesac that makes those giant bean bags.
Oh
You know what I'm talking
yeah,
about? So they
yeah.
started as e-commerce, and then they have retail stores, but basically he said it's just like marketing. Like they're not expecting to like that's like a physical experiential marketing play, and it's just most people go to the store and then they'll buy it like on their phone in the store, which is crazy. But like certain things people want to see. So that's another one we'll be looking at. Oracle.
Well,
Oracle had earnings yesterday. Did you track those at all, Shy?
I did a little. I mean, my stance on Oracle is that it was a pretty weak quarter, to be honest. I will say that for you have to ask like what's being priced into the stock. It's kind of expensive already on a fundamental basis. Let me see what their multiples are. They didn't. They miss on their current RPO was somewhat semi weak. I know Stargate really hasn't been reflected in any of their future guidance yet. But now trading at 23 times earnings, which doesn't actually look too bad. Actually, it does because they're only growing top line 8%. Like it's somewhat. I don't know. It's I think they're gonna thrive in a agentic AI world. It's just it got priced like look to the left. It got priced in a lot of like the news that they're supposed to
Yeah. I mean, rough
kind of.
timing to report. I think about too, Klarna's supposed to IPO here. Like, do you think that gets delayed just because everything's nuts? Or are they just going to power through? Because that was supposed to happen as soon as
I
this week. And now it's like,
I
I don't
I
know.
think it gets pushed. I think it gets pushed. I think I don't know. Core Weaver is supposed to go public. I think this week. That's a big one. But I
Yeah.
think a lot of those fintech names, I'd envision them being pushed because of the constraint that consumers are going to have in this
Yeah.
environment. And I
Right. We're
think
still waiting on Chime, I think, too.
and even Stripe,
Yeah.
like Stripe is still hasn't even gone public. Also, like they missed their window a bit. I think that whole sector, payment services, got re-rated aggressively in
Yeah.
the past 2 years, and that's not going to go back to what it was in 2021, 2022. Like it's not. They're clearly showing that the market sees them as tomato tomato. It's just not that different from one another, and they're going to get re-rated accordingly. There's not going to be a premium valuation associated with them, and I think we haven't seen. I there I've been talking to some people in the private markets because I love investing in private markets. Like I own data breaks, for example. Like I would love to own Anduril as well and like some other names like Figure AI, but like their valuations are through the roof because
Yeah.
they're getting a massive premium valuation in the private markets. They are. Every
Do you have
round
a
they
platform you use for that, Shy? I'm always curious because there's a
I
bunch of different
wish.
ones. Do you mind like sharing how you get access to those things, or is it just depends?
So the way I get access to those things is my network.
Okay.
As stupid as it sounds,
Because
I
there
have
are there's the
friends.
Equity Zen, there's Hive, there's Angel. Maybe AngelList you can do it on.
So I
Okay.
do it I do it through private placements with like
Okay.
a lot of the broke the hedge funds who do the funding
Mm-hmm.
themselves. So I know a lot of people aren't in that position. There's definitely vehicles out there that you can invest in private companies like SpaceX, for example. I think it's very accessible to actually invest in things that have SpaceX exposure.
Mm-hmm.
But for me, I like to actually own the raw shares, and I try to not do it in a way where I have to pay a 15% fee in order to do so.
Yeah.
And private placement is the way to do that. But yeah, I mean, the people I've been talking to in private markets, like, why would you a private company go public right now when they're no no hassle at all on getting
Yeah.
an updated valuation from the previous round?
It's a pain in
And
the ass being a public company. You start spending a lot
mhm,
of time and money on the reporting
100%.
side. I think there's also vehicles like ARK Venture Fund. There's Cashmere Fund. You could get into those portfolios, but it's not that direct line. But I think that there's been studies showing that people are interested in that, and even Vlad Tenev came out and said Robinhood wants to add that at some point. I think he said that a couple months ago. So the private market space could be heating up alongside the public.
Yeah, I mean, I would again, I will love it if there's it makes too much sense for like why can't I buy shares in a private company on Robinhood? Like it just makes too much sense. Like why do I have to wait till the IPO? But I
Yeah.
also do think like the visibility you mentioned, like it is what I believe is going to prevent OpenAI from ever being public. I don't think they're ever going to be public in the stock market. And that's a
Really?
bold statement to make, but I think they have a lot of incentual flow. By incentual, I mean like Microsoft, OpenAI, like it's just like so messy that it inflates their data a lot more than it really should. And I think they're not misleading investors, but like it's just a little bubbly and inflated because without Microsoft's arm, like who knows what the real situation is. I think by the time they iron that out, LLMs will be a commodity, a pure commodity, and they're going to get re-rated accordingly, and they're not going to be worth $200 billion or whatever their valuation is right now. So I think they're not going to go public, and I think unless they have a real angle on AGI. If AGI is a real thing for them in the near term, 12, 18 months, I think that's their angle on going public. But I
Open
just don't
AI, you're
think,
saying.
yeah, OpenAI.
Yeah.
I just don't think they're gonna want that visibility under the hood, go through all the shareholder drama, headache of being a public company. And we're so early in industrial revolution. Like I hate to say it, but like being a public company does have some kind of anchors on how much market share you can get and how the luxury of it. Like when I talk to people about in Databricks, the management people, like why would they go public? They can acquire these BI tools
Yeah.
at whatever cost they feel comfortable with and don't have to worry about the shareholder price dipping from overspending or just like all the drama of synergistic behavior that's they have to communicate to shareholders, and that's a whole effort in itself when they can just focus on getting the best platform and getting the best tools to put in that platform. As simple as that. So that's why Databricks is seeing what Snowflake's going through right now. It's a headache, and Databricks is paying up for their talent as well. They have high SBC costs most likely, and they're saying like that is a massive ankle weight on any valuation in the markets right now because they're seeing Snowflake getting punished for
Mhm.
40% of the revenue being an SBC. They don't want to go through all those headaches, so I don't blame them.
I love how we ended this outside of the public markets, which maybe we should take a look at before we bounce, see how things are going. Shy, are you watching anything in particular for the day today? Are you heads down, not looking?
So growth is having a major bounce today. If you're looking at Crowd,
Yeah.
Tesla, Cloudflare, they're all of 5%.
All right.
Palantir's up 4%. Spy's red. Mag 7 is not where you want to be this year. I think that's just literally the theme. I will say I did some trimming just now. I think I'm still defensive. It's a dead cat bounce to be honest. I think QQ like this is my final words. Like I think nothing has changed from yesterday to today on my defensive strategy except for stock price. But I'm still QQQ. I mean Spy. Let's talk Spy. Spy needs. Oh right, QQQ. Oh, all right, Q. Let's do Spy. Spy needs to clear 572. We are 2.5 to 3% away from that. So like we got a
Oof.
ways to go. If you go
Yeah.
on QQQ, we're even further, I think. QQQ, we have to do 493. That's like a 5% move. Like we're significantly below the 200-day moving average. Like we might have a dead. The market might go up 2% today. And everything's business as usual. No, we are still below the 200-day SMA. Like we're still in danger territory. That's what I'm trying to like get at. Where like even after today's like we're still not at the high of the day. Like we're fading. Like it's messy early on. Spy's red and like growth's catching a bid, but
We're leaving on a cliffhanger. It's
cliffhanger.
to
You're gonna
be
tune in tomorrow.
continued tomorrow morning, and we'll pick it all back up right here on StockTwits at 9 a.m. Shy, thank you so much. Hope you have an amazing Tuesday despite all the red.